Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So if you know me, you know I love looking at super investors portfolios. So their portfolios kind of show me some ideas of what to invest in. So I might see a company that I've never come across, do the research, and of course, you know, if I feel like it's a great investment, then I'll add it to my portfolio. But of course, the most important part is the fact that you're doing your own research. These guys are managing other people's money, so they have a target to meet. So there are things that they do, you know, there are things that I like about them, there's things that I'm not, you know, big fan of. So the things I like about them is the fact that they are of course managing other people's money, so they have to make sure their, you know, their portfolios are performing more or less better than the S&P 500. So they have to beat the S&P 500, or at least to be closer to the S&P 500. And the other bad thing is about them is because they have a target. So that means they might be selling, you know, they might be in and out of the market more than you would ever know. Like literally they might be selling one week and then buying the next week and so on. So you have to be careful with them as well, because you might find out that they actually bought a new shiny stock in this week, and then they invested in 3 months ago, the stock went up 20%, and then they sell it straight away. So you have to be mindful of that. So in today's video, I want to look at Terry Smith. We've looked at his portfolios before. We talked about some of the stocks, and in today's video, I picked 10 different companies that are Sharia compliant that are in his portfolio, and these companies have a few things in common, and I'll share that with you guys. If you don't know who Terry Smith is this guy. This guy here. So, and he has basically a company called Fundsmith, and he is British. He's based in the UK, of course. And one of his philosophies, so one of the things that he has basically talks about all the time, is the fact that when he's looking for stocks, this is his basically statement, okay? Buy good companies, don't overpay, and do nothing. Okay, so you're buying good companies, so you've done your research, and I'll show you exactly what he looks for in terms of good companies. Don't overpay, meaning do not buy stocks that are trading higher multiples, companies that are very expensive, because you can easily lose money. And do nothing, forget about them. Just leave them in your portfolio and hold them for a long term. And as you can pause the video and have a look at this basically when it comes to ROCE, which is similar to return on invested capital, but it's return on capital employed, gross margins, operating margins. You can see every single year he's basically his companies have a better gross margins than of course the S&P 500 or the FTSE 100. So it's really interesting to see his portfolio. And of course the information was based in 2022, but this was some of the things that were like sectors that were in his stock portfolio. But these are the things that he's looking for, okay? Economic sectors, so he wants companies including cyclical business, consumer defensive, technologies, telecommunication, healthcare, and so on. This is one of the things that he's looking for. ROCE greater than 14%, operating margins greater than 15%, net debt less than 5 times the trailing 12 months. Okay, net profit, the interest cover about 10x, profit price to free cash flow, and he's looking for price to free cash flow less than 30 or equivalent of the free cash flow yield of 3.3%. Normally we say we're looking for about 3% or more. Free cash flow for the last 5 years, so he's looking for the growth of that free cash flow last 5 years greater than 0, which basically means the company is profitable business and they actually have a free cash flow right now instead of being in the negative. And then market capitalization, basically the market cap, he says, has to be up more than 500. Okay, this still is his philosophy. This is still what he's looking for. So let's now have a look at the 10 companies that he has in his portfolio that are meeting those criteria more or less. Some of these companies will be very expensive right now, so be mindful of that. And some of these companies are slightly basically undervalued. So return on invested capital I've highlighted, and total return, because these two things are, so the return on invested capital are high for these companies apart from one, and total return, they've done absolutely amazing job over the last 5 years. Growth estimate for the next 5 years is also good for the companies that he has in his portfolio. So I'm just going to skim through some of them. Okay, so some of these companies we've never come across, and as you can see here, this company basically Rawlings, he basically has a market cap of $23 billion. I'm not going to say what the company does. It's going to take, I don't want to make the video any longer than it needs to be, but if you're interested, you can of course look at any of these companies in more detail. It has a wide economic moat, $48 dollars of price right now. Dividend yield of 1.3, payout ratio is 60%. Now anything above 60% is basically, we say 61%, we say it's not safe, so below that would be nice. And latest increase 15%, the 5-year growth rate of 17%. Last 3 years is basically they've increased that dividend for the last 3 years, and right now they will give you $6, basically 60 cents for every share of this company that you own. Because they're very small cap company, is absolutely fine and is growing. In terms of safety wise, 83%. The last 5 years they basically compounded that revenue about 11%. EPS, earnings per share, is right now about 15% of the last 5 years. Profit margin 14%, return on equity of 35%, and return on invested capital, which is similar to ROCE, okay, is 30%. Okay, free cash flow is slightly different how it's calculated. It takes the net both of them in net income anyway, so I mean net operating profits. So free cash flow right now we're looking about just half a million, okay, half a billion, 500 million, sorry. And as you can see here, the company is quite small, so $23 billion, about 500, which is absolutely fine. It covers the dividends, of course. And total return the last 10 years, every single year you would have had 20% total return on your investment, which is absolutely amazing. Growth estimate next year 13%, 13% after that, 29% premium right now. $37 per share is where they think the price should be. The next company we're going to look at is Apple. You might be surprised and say, why are we talking about Apple? Apple is still a Sharia compliant company, by the way, and I sold this company a while ago because of the credit situation they have. So they, at the time, they were getting into credit cards. They, of course, they have the music section, they have the TV section. But having said all of that, their business side of things is still less than all of that. When you take into consideration the business screening is still less than 5%, or basically of the entire business. So which is basically still Sharia compliant. So $3.3 trillion, if not, is the second biggest company. I think Microsoft was, no, Nvidia is now, I think, and Apple, and then Microsoft. I can't remember how they order, but anyway, one of the biggest three anyway. As we know a lot about this company. The dividend yield is not great right now. However, the growth side of it is absolutely amazing to see, because only 15% of their net income they're spending on basically paying us dividends, and it's not growing fast. I would expect this slightly higher, but of course this company buys back shares a lot, so take that into consideration when you talk about Apple. 11 years of increasing it, $1 is what you will get for every share that you own. 99% safety right now. The 5-year, I was surprised that they basically about 8% grew about that in revenue, about 8% in the last 5 years, and the 21% when it comes to EPS, which is quite nice. 26% profit margin, 160 when it comes to return on equity, 72% when it comes to return on invested capital, over $100 billion of free cash flow, which is absolutely ridiculous. Some of these companies are not even 100 billion market cap, let alone having that sort of a free cash flow. So 25% total return in the last 10 years, 12% expected to grow about 12% next year in terms of earnings, and then 10 years after that, 10% after that. Premium right now about 18%, $185 per share. Right now is $120 to $1 per share. Another one that we've talked about recently is a Fortinet. This is one of the cybersecurity companies. $53 billion. The company has actually bounced back recently. It was way undervalued. Right now it's become fair valued, and as you can see here, $77 per share. 71 is where it's at now, so not far off. Of course it has a wide economic moat, and profitability side of it is really, really good company. And when it comes to return on invested capital, you're looking at over 100%, which is absolutely amazing. A $1.5 billion of free cash flow, 30% total return in the last 10 years, and they're expecting almost double digits growth in the next 5 years, which is absolutely amazing. Now the next one is one I have not come across. Is a very small company, only $6 billion, but it has a narrow economic moat. As you can see, right now the price is $39 per share. Small dividend, okay, but the payout ratio is very low. They're growing that dividend nicely. They've done that for the last 8 years, and they will give you about 30 cents for every share of this company that you own. That dividend is definitely safe, but growth side of it is not there. So I'm not sure why he owns this company. Really interesting, because it's the only one that has not got double digits when it comes to return on invested capital. The rest of them are absolutely fine. So it will be interesting to know why he owns this one. And it's only 7% return last 10 years. But they are expecting massive growth in basically this year. I don't know if that's organic, meaning they actually organically grow in that business, or is it they've acquired another business, so they adding that business to their business, so that for that reason the EPS is growing that much, or whatever the case might be. So, but the next 5 years they're expecting about 3%. So 8% discounted right now, $42 per share is where they think the price should be. Next two, I'm going to do exactly them together. Well, I'm going to do them together if I can speak. Visa and MasterCard. These two companies, one of the things that I've realized is no matter whose portfolio you look at, especially those super investors that are managing a lot of money, you will find either Visa or MasterCard or both of them, including Warren Buffett. I think he owns both. So it's really amazing businesses. And I get a lot of questions about, are they Sharia compliant? Of course they are, because they actually deal with the transaction side of it. They don't deal with the, they're not a bank. They're not loaning out the money and getting riba based on or interest based on whatever. They are facilitating that transaction. They're basically a tech company. Okay, so the technology that's in the facilitating the transaction is what they deal with. And we've talked about these companies a lot, so I just want to give you a quick highlight. Of course, both of them are huge companies. They have a wide economic moat. Right now, in terms of dividend, not huge, but the payout ratio is very low, and they are basically increasing that massively every single year, double digits, which is absolutely nice. One is been paying 15 years, another one 12 years, and of course there's about $2 for each. Safe, absolutely. They're growing that revenue, they're growing that EPS, and look at this part, absolutely amazing. Okay, when it comes to profit margin, return on equity, and return on invested capital, really wonderful businesses to own. Free cash flow is absolutely amazing. Total returns are really good, and they're expecting the business to grow, EPS to grow about double digits in the next few years, and it's fairly valued, both of them right now, $272 per share, $451 per share for this one. So stay tuned until the end. So I'm gonna show you, I'm gonna basically buy a stock, so I'll share that with you guys. As always, I'm gonna keep sharing my journey with you, and that means when I buy and sell, I will let you guys know. So InshaAllah, if I will be doing some buying today, so just stay tuned until the end. And by the way, just to let you guys know, if you have not joined us on the Patreon account, please do so. It really helps the channel. It costs you 15p. And the most important thing for me is that you've liked the videos, you share with your family and friends, and get the get it out there, inshallah, as much as you can. Let people know about what we're doing here, inshallah. So hopefully we can reach out more brothers and sisters. The next one is a company that I own in my portfolio. That's Automatic Data Processing. I've talked about this company so many times, but as you can see here, dividend yields really good. The payout ratio is quite low. They are increasing that dividend. They are dividend king now. 50 years of increasing that dividend. You get $5.60. Is absolutely safe. They're growing the business nicely, so that's 6% and 13% when it comes to revenue and EPS as well. Return on invested capital, return on equity, profit margins, all of these things doing absolutely amazing. Nothing to worry about. Free cash flow $3.5 billion. Total return the last 10 years 14%. They're expecting basically 9% growth for EPS in the next 5 years, and fairly value running $280 per share. Now the next one he owns is this one here. This company I think I've talked about here and there a few times. As you can see here, the market cap is about $39 billion right now, which is not huge, but they have a narrow economic moat. Current price $490 per share. No dividends, of course. Right now, they're growing that revenue about 11% for the last 5 years. They grew that EPS about 11% compound annual growth rate. Profit margin, return on equity, and return on invested capital, absolutely amazing. Less than $1 billion of free cash flow right now. Total return the last 10 years 22%, and they're growing that revenue double digits next 5 years. And as you can see here, it's actually a little bit expensive. They're expecting about $400. It's about $90 basically, and lower than where it should be, basically, according to Simply's Morningstar. Another one that we have not, I think I've spoken about this company a few times here and there, is $14.5 billion, narrow economic moat, and $193 per share. Now in terms of dividends, absolutely nothing to worry about. It's really good. They have increased it for the last 5 years. 8% every single year for the last 5 years, which is quite good. And then if you look at the safety, 95%. Now EPS and the revenue is growing about 5%, so it's not huge, it's not fast growing company if you think about it, but they are doing well when it comes to profit margin, return on equity, and return on invested capital. 640 million free cash flow right now, and total return the last 10 years about 11%. Again another double digits, another also double digit growth for the next 5 years, which is very interesting as well. And it's fairly value right now, $214 per share is where they think the price should be. And finally, Church & Dwight is basically the last company we're going to talk about today, about 25 billion market cap. This company has absolutely no economic moat right now, and dividend yield is absolutely fine. The EPS in terms of payout ratio is fine. Growth is not there, but they are a dividend aristocrat, so they are a list of companies that have increased that dividend 25 years or more. So 27% right now. $1.14 is what you will get for every share that you own. Safety 99%. And then last, when it comes to last 5 years, where you can see the revenues being growing about 7% per annum, and EPS about 12%. Now profit margin, return on equity, return on invested capital, again another thing these companies have in common, really good as well, above what he's normally looking for. 784 million free cash flow right now, double digit when it comes to total return the last 10 years, expected to grow about earnings about 9%, and 48% premium, so very expensive. $68 per share is where they think the price should be. Right now it's about $100 per share. Now you can pause the video and have a look at these companies, and you need to do your own research. Don't just take my word for it. Okay, this guy, of course, I'm not buying any of these companies because he's buying it. If it basically meets your own criteria and things that you've got on your list, then of course by any means go for it. And final thing I want to talk about and show you is the Sharia compliance side of things. And one thing I've noticed is these companies do not have that much of a debt. Remember, one of the things that he has, okay, is this part here where we talked about net debt less than 5 times the trailing 12 months of net profit. So maybe it's something to do with that. But when it comes to interest-bearing debt and interest-bearing securities, absolutely nothing to worry about. And of course the Sharia compliance side of things, like I said to you guys, Apple is basically 99% when it comes to, and this is according to Zoya. There are other companies out there, even I think Musafa, I think is called, that it's more or less exactly the same when it comes to Sharia compliance side of it. Anyway, that's the 10 companies I wanted to share with you guys today that this guy owns. And as I always say to you, please do your own research. And if you can join us in the Patreon account, it will genuinely mean the world to me. And of course, you get a lot of things out of it, inshallah. Even if you trial it out for 1 month, and of course, you get what you wanted, inshallah. Hopefully, you can stay with us. If not, of course, you can always change your mind. Have a wonderful day. Assalamu Alaikum.